Do you believe that just by sitting still and doing almost nothing, you could end up wealthier than 90% of investors out there? That's right. Most people lose money not because the market is too difficult, but because they trade too often, pay too many fees, and let their emotions take over. John Bogle, the father of index funds, proved that if you want to build lasting wealth, all you need is simple, disciplined, and patient investing. In today's video, I'll share with you the 6 most valuable lessons from the Little Book of Common Sense Investing, a book that completely changed the way Americans invest and build long-term wealth. If you want to learn how to make money work for you instead of constantly chasing the market, hit like and follow this channel right now so you won't miss future summaries of investment books that can transform your mindset and your financial future. Part 1. The core of the investment philosophy. John Bogle begins with a tough truth. Most of us will never beat the market over the long run. Not because we're not smart enough, but because we lose on 2 invisible battlefields: costs and emotions. The more you trade, the more fees you pay. The more you let fear and greed drive your decisions, the more your real returns get eaten away. So what's the smarter path? Bogle says, don't try to beat the market, own the market. A total market index fund, or even just the S&P 500, is basically buying a basket of large companies, allowing you to grow alongside the entire US economy instead of betting on just a few names. When you own the index, you share in the profits, dividends, and long-term growth of America over 10, 20, or 30 years, without having to predict what happens tomorrow. Bogle calls this common sense investing. The simpler, the better. You don't need to time your entry into Apple or Costco. You just buy the whole haystack instead of hunting for the needle. Broad diversification reduces the risk of putting all your eggs in one basket, while the ultra-low costs of index funds ensure more of the returns stay in your pocket. This difference might look tiny in a single year, but over 30 years, it becomes massive. Imagine 2 investors. Alex chooses an actively managed fund with a 1% annual fee. Jordan picks an index fund with a 0.05% fee. If the market's long-term return is around 7% before fees, then after 30 years, Alex's initial $10,000 might grow to about $57,000, while Jordan's grows to nearly $75,000, a gap of more than $17,000 starting from the same place. And if both invested $500 a month for 30 years, that tiny fee difference could snowball into more than $100,000. That's compound interest working for you or against you depending only on fees. Real life shows this clearly. A teacher in Ohio steadily contributed to her 401k index fund starting at 25. No predictions, no buy the dip, sell the rally, just automatic deposits every paycheck. By retirement, her account far outpaced her neighbor, who spent years chasing stock tips, trading in and out, racking up fees, short-term taxes, and panic selling every time the market dipped. A nurse in Texas opened an IRA with a total market index fund, rebalanced once a year, and ignored the daily headlines. After a decade, her boring discipline led to steady growth, less drama, more net worth. Meanwhile, another friend got swept up in meme stocks, buying options during the frenzy and panic selling when things turned red. After a few years, what he had left was mostly tuition paid to the market. Bogle would say, that's not the market's fault, it's costs and emotions eating away your gains. Bogle's core message is simple but powerful. Own the market, keep costs low, and let time do the heavy lifting. You don't need genius to succeed. You need a system that's simple, transparent, and boring enough to stick with. Because it's exactly that boring consistency that gives you a shot at capturing America's long-term growth. When you stop chasing big wins and start steadily building wealth through index funds, you stop being a gambler on the news cycle and start becoming a co-owner of American business. And that's how common sense turns into financial freedom over time. Part 2. The power of compounding and low costs. John Bogle emphasized that 2 forces shape your financial future: compound interest and investment costs. One is your most loyal friend, steadily growing your money over time. The other is an invisible thief, quietly stealing away your returns. Imagine you invest $10,000 and leave it for 40 years. At an average annual return of 8%, it grows to about $220,000. But if you only earn 7% because of a 1% management fee, your money ends up at just $150,000. That's a loss of more than $70,000, enough to buy a small house or pay for a child's college tuition. If your net return drops to 6%, you finish with only $100,000, losing over $100,000 compared to the original scenario. All of that simply because of fees. Now, picture contributing $500 a month for 30 years. At 8%, you'd end up with nearly $750,000. But if your real return is only 6%, the total falls to about $500,000. That's more than $200,000 gone, just because of higher costs and not letting compounding fully do its job. And this isn't just numbers on paper. Think of Ronald Read, a humble janitor in the US. He never won the lottery, never ran a big business. He simply bought stocks, held them, kept his costs low, and let compounding take care of the rest. When he passed away, his wealth had grown to more than $8 million, which he left to his community and family. Contrast that with countless others who chased short-term trades, pay high fees, switch funds constantly, and after 20-30 years end up with only modest savings because their returns got eaten away by costs and poor timing. Bogle believed the secret to lasting wealth isn't about being smarter than the market. It's about being more patient and more frugal than others. You don't need to find the golden stock. You just need to avoid losing money to fees and give time and compounding the chance to work for you. The takeaway is, if you want to build real wealth, remember 3 things. Start early, invest consistently, and choose low-cost tools. Compounding will work its magic as long as you give it enough time. Part 3. The reality of active funds. Many people believe that if they just pick a brilliant fund manager, that person will beat the market and deliver superior returns. But John Bogle showed that in reality, the opposite is usually true. Active funds charge high management fees, often 1% to 2% per year, plus hidden trading costs as managers constantly buy and sell stocks. That might sound small, but over time, those fees eat up a huge portion of your returns. As we saw earlier, even losing just 1% a year can cost you hundreds of thousands of dollars over several decades. But the bigger issue is this: most active funds simply don't outperform the market in the long run. Data from S&P Dow Jones indices shows that more than 80% of U.S. active funds underperform the S&P 500 after 15 years. In other words, by just buying a low-cost S&P 500 index fund, you already outperform 8 out of 10 professional managers. One famous example is Warren Buffett's $1 million bet. In 2007, Buffett wagered that a low-cost S&P 500 index fund would outperform 5 hedge funds managed by top Wall Street experts over 10 years. The result? By 2017, the index fund returned about 125%, while the hedge funds averaged only 36%, a massive gap. Buffett won the bet and donated the money to charity. But more importantly, he proved Bogle's point that most managers can't beat the market, and you don't need to pay high fees to follow them. Think of it like running a marathon. An index fund is like running steadily, keeping your pace and focusing on finishing strong. An active fund is like constantly darting off the track, searching for shortcuts, only to end up more exhausted and still finishing behind. The market is tough to beat, and every attempt costs you in fees, taxes, and mistakes.
Bogle's message is clear. Don't bet on someone else's ability to predict the market. Bet on the market itself. Buy a low-cost index fund, hold it for the long term, and you'll already be ahead of most of Wall Street's so-called experts. Part 4. Index Funds, the Simple Path. In the world of investing, many people are drawn to complicated strategies, dense charts, and secret formulas that promise huge returns. But John Bogle believed that simplicity is the greatest strength. An index fund works in a very straightforward way. It simply buys all the stocks in a market index, for example, the S&P 500, which includes the 500 largest companies in the US, and then just holds them. There's no constant buying and selling, no guessing which companies will win or lose. As the US economy grows, the value of those companies rises, and you, as the investor, benefit. It's so simple that many people didn't believe it at first. Yet the truth is, index funds have helped millions of ordinary Americans become successful investors without needing deep financial knowledge. For example, a teacher in California shared that he consistently invested in an S&P 500 index fund throughout his 30-year career. He didn't need to study charts or track the news every day. By the time he retired, thanks to the power of compounding and the steady growth of the market, he had over $1 million in his account, far above the average result of most individual investors. The simplicity of index funds also protects you from emotional mistakes. People often fall into herd mentality, excited when the market goes up, panicked when it goes down. Individual investors tend to buy at the top out of fear of missing out, and sell at the bottom out of fear of losing more. But with index funds, you don't have to chase the market. You just keep investing steadily and hold on. As Warren Buffett once said, an investor doesn't need to do anything other than consistently invest in a low-cost index fund. Over the long run, that will outperform most Wall Street professionals. In other words, you don't need to be a genius to succeed at investing. You just need to choose the simple path, stay patient, and let the market do the heavy lifting.
Part 5. Discipline and long-term investing. John Bogle emphasized that investing is not a sprint, it's a lifelong journey. Success doesn't come from quick wins, perfect buying the dip, or lightning-fast trades. It comes from discipline, patience, and persistence over time. Imagine this. You invest $500 a month in an S&P 500 index fund, earning an average of 8% per year. After 10 years, you'd have about $90,000. After 20 years, that grows to more than $275,000. And if you stay disciplined for 30 years, the total surpasses $750,000. All from patience and consistent investing, not risky bets or complex financial strategies. The key is this: the market will always be volatile. At times, it will drop 20%, even 50%. But those who panic and sell during downturns are usually the ones who lose the most. Meanwhile, disciplined investors who hold steady and even keep buying when prices are low end up as the true winners. A clear example is the 2008 financial crisis. Many investors panicked and sold everything as the market collapsed. But those who patiently held their index funds watched their portfolios recover strongly within a few years and then soar to new highs in the following decade. Even Warren Buffett, one of the greatest investors of all time, once said, "My favorite holding period is forever." In other words, instead of chasing the market, let time and the power of compounding do the heavy lifting for you. Long-term investing requires discipline because it goes against human nature. We all want quick results, but sustainable wealth only comes from persistence over years, even decades. The message is crystal clear. Don't let emotions control you. Let discipline and time work in your favor. Part 6. Bogle's life philosophy and legacy. John Bogle was not only a great investor, he also left behind a simple yet profound life philosophy. Put investors' interests first, live humbly, and pursue integrity in everything you do.
When he founded the first index fund in 1976, Bogle didn't get caught up in promises of quick wealth or Wall Street's complicated schemes. He chose a different path, a path of simplicity, transparency, and low costs. This philosophy gave millions of ordinary investors access to the financial markets and a real chance to build lasting wealth. People often called Bogle Saint Jack, not because he was the richest, but because he gave back the most to the community. It's estimated that thanks to his low-cost index fund philosophy, investors worldwide have saved hundreds of billions of dollars in fees. That is a legacy not only in finance, but also in the way people think about fairness and transparency. Bogle once said, "Success is measured not by the money you make, but the difference you make in the lives of others." This sentiment runs throughout his book and is what elevates his thinking beyond investing, turning it into a life philosophy. Bogle's final message to us is clear. Invest simply. Avoid unnecessary complexity. Stay disciplined and patient over the long term. Above all, live with integrity and responsibility, leaving value for those who come after you. By following these principles, you not only build wealth for yourself, but also live a meaningful life, just as Bogle did throughout his remarkable journey. If you found John Bogle's lessons valuable, hit like to show support and follow the channel so you don't miss future deep dive summaries on investing and personal development. Remember, lasting wealth isn't about complexity or luck. It's about simplicity, discipline, and patience.